All right, let's jump right in. Today, we are tackling a really fascinating puzzle that's right at the heart of modern finance. We're always trying to figure out what's coming next, but how do markets actually put a hard number, a precise dollar and cents price, on something that hasn't even happened yet? How on earth is that done? Well, let's find out. I mean, really think about it. A derivative is just a contract, right? Its value depends entirely on some future event, what the price of a stock will be next month, or where interest rates are going to be next year. At first glance, pricing these things seems like it should be just impossibly complicated, like a total mess of guesswork, predictions, and gut feelings. But it turns out the logic is surprisingly clean and elegant. So, to understand this, let's first look at how we price normal stuff, like a regular old share of stock. The traditional way is, well, it's a little fuzzy. It really involves trying to predict the future, which, let's be honest, we humans are not very good at. So value a stock, you try to forecast its future price, its dividends, and then you discount all that back to what it's worth today. But what discount rate do you use? Well, that depends on how risky you think the stock is. See, investors, we're generally risk-averse. We demand a little something extra, a potential extra return called a risk premium, to convince us to take on all that uncertainty. And how much extra is that? Who knows? It's subjective. It literally depends on investor opinions and emotions. This is not what you'd call a precise science. Okay, but here's what's so cool. Derivatives pricing just throws that whole subjective mess right out the window. It uses a totally different, much more powerful and logical principle. A principle that doesn't require us to guess what the future holds or how nervous investors are feeling. It all boils down to one simple, beautiful rule. There's no such thing as a free lunch. In the world of finance, that free lunch has a very specific name: arbitrage. It's basically the art of finding a guaranteed 100% risk-free profit. Imagine finding two identical gold bars, but one is selling for $1,000 and the one right next to it is selling for $900. Arbitrage is just the simple act of buying the cheap one and selling the expensive one at the exact same time and instantly pocketing a risk-free $100. As you can probably guess, those kinds of opportunities don't last very long. And this process is purely mechanical. There is zero risk because the two trades happen at the same instant, and they perfectly cancel each other out. It's the combined actions of thousands of traders all hunting for these tiny price differences that keeps the entire market in line. It is a really powerful, self-correcting force. And this quote just nails the core idea. The constant hunt for arbitrage opportunities enforces what's called the law of one price. It's simple. If two different things give you the exact same result in the future, they absolutely must have the same price today. If they don't, traders will pounce on that difference until the prices are forced back together. So this is the absolute key takeaway. Derivative pricing isn't a forecasting competition. It's a logic puzzle. You price a derivative by figuring out how to perfectly combine it with the underlying asset to create a totally risk-free portfolio. And since that little combo is risk-free, it has to earn exactly the risk-free interest rate, no more, no less. And here's the magic. There is only one possible price for that derivative that makes this true. Any other price would create an arbitrage opportunity, a free lunch, and the market, in its constant hunt for profit, would stamp it out instantly. All right, so let's see how this whole no free lunch rule actually works in practice. We'll start with the first big family of derivatives, forward commitments. And the key word here is commitment. These are contracts where you are locked in. You have an obligation to do something down the road. The classic example here is a forward contract. It's a really simple agreement. Let's say you and I agree today that in 3 months, I will buy 1 ounce of gold from you for, $2,000. It doesn't matter one bit if the price of gold skyrockets to $3,000 or crashes to $1,000 in those 3 months. We are both obligated, we're locked in to follow through on our deal at that price we agreed on. Now, here's a really crucial detail about how these things get set up. When a forward contract is first created, no money actually changes hands. It's just a promise. And because of that, the price is set in a very specific way, so that the contract's initial value to both me and you is exactly zero. It's neither a good thing nor a bad thing for either of us the moment we sign it. So how do you set a price that makes the value zero? You use the no arbitrage rule, of course. The forward price isn't some wild guess about the future. Nope. It is simply today's price, the spot price, grown forward at the risk-free rate of interest. That's it. And why? Because any other price would allow for arbitrage. You could buy the asset today and sell it with the forward contract to lock in a guaranteed profit bigger than the risk-free rate. The market just won't allow that to happen. Okay, so if forwards are all about being locked into an obligation, the second family of derivatives is the complete opposite. These are called contingent claims, and you've probably heard of the most famous ones, options. If forwards are about obligation, options are all about having a choice. An option gives you the right to do something, but you don't have to do it. Think of it like putting a non-refundable deposit down on a house. You've paid for the right to buy the house at an agreed price. But hey, if you change your mind, you can just walk away. The only thing you lose is your deposit. With an option, you pay a fee, we call it the premium, for that exact same kind of choice. Now, this is where things get really counterintuitive and kind of fun. In most of life, volatility, risk and uncertainty, that's a bad thing we try to avoid. But for someone who owns an option, volatility is fantastic. Why? Well, because an option holder's potential loss is capped. The absolute most you can ever lose is the premium you paid for it. But your potential upside, it's unlimited. So the more the asset's price swings around like crazy, the greater the chance it has of swinging way up, leading to a massive payoff for you. Volatility just increases your chances of hitting a home run, while your downside stays exactly the same. So let's just put it all together here, because this slide shows the fundamental split perfectly. On one side, you have the forward commitments. They're all about obligation. Their value starts at 0, and their price is just a calculated number designed to stop those free lunches. On the other side, you've got options. They're all about the right to choose. Their value starts as the premium you pay for that right. And crazy enough, their value actually goes up with uncertainty and volatility. Once you understand this logic, it really changes how you see financial pricing. It's not about crystal balls. It's not about trying to predict the future. It's all about creating consistency and eliminating paradoxes using pure, cold logic. So let's recap the big takeaways here. First, and this is the most important one, remember that pricing derivatives has nothing to do with gazing into a crystal ball. It's a logic puzzle, plain and simple, built entirely around preventing those free lunch arbitrage opportunities. Second, because of that, a derivative's price is mathematically locked to its underlying asset and the risk-free interest rate. That totally removes all the guesswork about investor feelings. This whole elegant idea is known as risk-neutral pricing. And finally, don't forget that fundamental split. Pricing an obligation, like a forward, is a completely different world from pricing a choice, like an option. And that leaves us with one last big thought to chew on. We've just spent this whole time seeing how derivatives are priced by creating perfectly hedged, risk-free positions. The entire logic is built on eliminating risk. So if that's true, why do we always hear stories about derivatives being these incredibly risky instruments that can blow up entire companies? Now that is a puzzle for another time. Thanks for watching.